Okay, let's dive into this. If you're a sophisticated retail investor trying to find a true ground floor opportunity in the global energy space right now, well, you really need to be paying close attention to American liquefied natural gas. Specifically, we're talking about Venture Global, ticker symbol VG. Now, right off the bat, I have to tell you, this isn't your granddad's slow-moving utility stock. Not at all. This is what we call a high beta investment. It's volatile, it's aggressive, and frankly, it represents a massive potential opportunity if you've got the right risk profile for today's market conditions. So let's break down exactly what makes this company tick.
Here is the roadmap for our explainer today. We're going to trace the thesis from the top down. Number 1, their status as a true LNG market disruptor. 2, their explosive financials. 3, the spot market strategy. 4, stock price and catalysts. 5, navigating the major risks. And finally, 6, the midterm investment verdict.
All right, Section 1, the LNG market disruptor.
So when founders Michael Sable and Robert Pender started Venture Global, they basically looked at what the massive energy supermajors were doing and decided to do the exact opposite. For decades, legacy companies have relied on these traditional stick-built projects. We're talking totally bespoke engineering marvels built completely from the ground up right on the site. And you know what? They're incredibly expensive and they take absolutely forever to build. But Venture Global, they flip the script. They use a completely modular approach. It's a design one, build many philosophy. Basically, they use these mid-scale, factory-fabricated liquefaction trains made by Baker Hughes. Think of it kind of like assembling a car in a super-efficient factory, and then just shipping the completed chunks to the site to plug them in. It's brilliant.
Now, to really grasp why that modular approach is a total game changer, we have to talk about FID, or Final Investment Decision. In the industry, this is the exact moment a company officially locks in the capital to actually build a project. Normally, the industry standard time from that FID moment to producing your first drop of LNG, it's a grueling 5 to 7 years. But because of Venture Global's factory-built model, they average just 30 months. They are literally cutting the timeline in half. And look, in an industry where time is quite literally billions of dollars in tied-up capital, moving that fast is a massive, massive competitive moat.
Let's move on to Section 2, explosive financials and growth.
Now, what's really interesting here is that this modular concept isn't just some neat little engineering trick. It is generating massive, tangible cash. I'm talking $13.8 billion. That is Venture Global's staggering revenue for fiscal year 2025. Just let that sink in. But what you really need to take away from this is the sheer velocity of that growth. That's a 177% increase over the previous year. And that massive surge, it was mostly driven by the rapid ramp-up of their Plaquemines LNG project, which exported 234 cargoes in just its first full year of commissioning. Incredible.
And all that top-line revenue is falling beautifully to the bottom line. For the full year 2025, they posted $5.2 billion in income from operations, with consolidated adjusted EBITDA at $6.3 billion. Think about that. With total assets sitting at $53.4 billion, this operating income completely proves that those assets are aggressively yielding results. They aren't just building things fast, they are monetizing them incredibly fast. Which brings us to Section 3, the spot market strategy.
Okay, this is the commercial strategy that really defines their high beta market position. See, most LNG producers like to play it totally safe. They lock up about 90% of their production capacity into super predictable 20-year contracts. But Venture Global, they intentionally keep roughly 25% of their capacity completely uncontracted. They hold it back specifically for the spot market. Now, why on earth would they do that? Well, because when geopolitical supply shocks hit and global energy prices just absolutely spike, the guys locked into those fixed contracts completely miss out. Venture Global, on the other hand, is uniquely positioned to instantly sell that retained capacity at a massive premium, capturing all that upside directly for their bottom line.
But I gotta tell you, that highly lucrative strategy comes with a darker, extremely controversial side. During the initial phase of their Calcasieu Pass or CP1 project, this was from 2022 to 2025, they exported over 200 cargoes to the spot market. And they did this while technically claiming the facility was still just in its commissioning phase. Now sure, this maneuver generated absolutely billions in immediate cash flow for them, but it infuriated legacy players like Shell and BP, who were basically left standing on the sidelines waiting for their lower-priced contracts to officially kick in. And you know, nothing brings corporate competitors together quite like a shared grievance, right? Predictably, this triggered an absolute wall of litigation.
Let's move to Section 4, Stock Price and Catalysts, and see how this builds the current market opportunity. The journey of the VG ticker has been an absolute roller coaster. The company IPO'd in January 2025 at $25 a share. But when the sheer weight of all that litigation from the energy majors really hit the market, the stock just cratered. It hit absolute lows of $572 in January 2026. However, if we look at where we are right now, in March 2026, the stock is trading around $13.16. Guys, that is an incredible 150% rally from the bottom. Mostly, this was driven by some huge recent legal wins against Repsol and Shell. And now, analysts are projecting that over the next 6 to 9 months, we could see targets ranging from $16 all the way up to $21.
So what's actually going to drive the stock up to that $21 range? Well, here are your short-term bullish catalysts. First up, continued on-budget progress of their massive CP2 project. Second, we have the official commercial operations date, or COD, for Plaquemines Phase 1 coming up in Q4 of 2026. That is huge because it locks in stable 20-year revenues. Third, there's a very real potential for inclusion in the S&P 500, as a multi-billion-dollar large cap getting added to the S&P would trigger automatic massive institutional buying from index funds. And finally, any geopolitical supply shocks, like what we've been seeing in the Middle East, that keep spot prices elevated will disproportionately benefit VG's uncontracted volumes.
Let's jump to Section 5, Navigating the Major Risks.
Now, as a sophisticated investor, transparency is key here. We have to ruthlessly weigh all that upside against some genuinely severe fundamental risks, objectively balancing the scales. On the bullish side, you have incredible momentum from CP2, guaranteed long-term take-or-pay contracts, and macro trends really pushing for U.S. energy dominance. But on the bearish side, high interest rates are putting serious pressure on net margins, and incredibly strict methane regulatory scrutiny could definitely delay future permits. But look, the crucial point is the biggest elephant in the room, the BP arbitration. BP still has a massive $6 billion claim against Venture Global over those commissioning cargoes. If there's a negative ruling in the upcoming 2027 quantum hearing, it could seriously shock the stock and hammer their liquidity.
And speaking of liquidity, you really have to consider the massive outstanding debt load that Venture Global subsidiaries are carrying. As of late 2025, that number sits at a whopping $34.8 billion. Make no mistake, this company is highly leveraged. They borrow very heavily to build as incredibly fast as they do. Now, as long as revenues keep compounding, they can absolutely service it. But this debt load is exactly why this is a high beta play, and for sure, not some safe haven asset. We also just briefly need to touch on geographical concentration risk. Almost all of Venture Global's major assets are heavily concentrated right down in southern Louisiana. And in the energy sector, that means one thing: extreme vulnerability to catastrophic hurricanes. If a major storm hits the Gulf, it could literally disrupt operations across their entire fleet of terminals. It's a critical factor you just can't ignore for any energy hold in this region.
Finally, Section 6, the midterm investment verdict.
Okay, we've looked at the short-term catalyst window. But what if you're building out a portfolio for the next decade? Well, here is the structural path Venture Global has to walk over that 5 to 10-year midterm horizon. Step 1, smoothly operationalize the 68 million tons per annum, or MTPA, of capacity they currently have built or underway. Step 2, hit that Plaquemines Phase 1 COD to firmly secure those bedrock 20-year revenues. Step 3, successfully bring the massive $20 billion CP2 project fully online. And Step 4, reach their ultimate grand goal of 100 MTPA. Because if they hit 100 MTPA, supported by their vertically integrated pipelines like the Blackfin and their own shipping fleet, they stop just being an exporter. They literally become a true global price setter in the LNG market.
So what does this all mean? It leaves us with one ultimate provocative question. For you, as an investor, does the massive upside of hitting 100 MTPA capacity and totally disrupting the market with modular builds outweigh a $34.8 billion debt load and a looming $6 billion arbitration risk? It is literally the definition of a high beta energy play. The floor could be low, but the ceiling? It could be absolute market dominance. Assess your own risk tolerance, run your own numbers, and I highly recommend tracking their next earnings call to see exactly how this story unfolds.